Good evening, everyone. Welcome to Moffin on Money, Saturday Night Live and Rambling. I'm joined with the illustrious, infamous, well known, sweet, and beautiful Miss Ellen.
Hi, everybody.
Appreciate you all joining. Now, who all's with us tonight? Tell us a little bit about yourself. Where you from? Don't want any personal information, yeah, obviously, but just want to wish everyone, tell you, I hope you're having a great Easter weekend. We've still got a few people joining us, so we'll just kind of make introductions here. Zanza Tired, our well known, much loved Toots. Is that correct?
We love Toots.
And is it Predator 7? Welcome. Glad to have you. And then Sandra. Sandra is actually doing us a big favor tonight. She is helping to moderate the chat. We want to start off asking for thoughts and prayers for one who can't be with us tonight, Secret McSquirrel. As many of you may remember, Secret has hosted our broadcast ever since it began. But dear sweet soul, we love her, but she is having some issues and wasn't able to join us tonight. So we'd just ask that you would lift her up in your thoughts and prayers. And Sandra, we thank you for agreeing to help us out tonight moderating until Secret can return. We're extremely grateful for that.
Yes, absolutely. Thank you. And of course, Zan's tired. Toots is so much easier to pronounce. Her sister is about to have a baby, and she is sitting there waiting for this little niece to be born. So thoughts and prayers to your sister.
I was going to ask if it's boy or girl.
Niece would be girl.
Little niece. Well, I'm not reading the chat. Sorry about that. I just saw it in the chats. Just reminds me of the best days of my life when my little baby was born. I kind of thought I would prefer having a boy first because I was a younger brother, had an older sister. And, you know, some of the older guys would be giving her grief or mouthing off or whatever, and I'd try to get involved, and I'd end up getting my face, you know, shoved in the dirt. So I always thought if I had my druthers, it'd have been better to be an older brother. But I think God knew what he was doing when giving me a daughter, because I was able to be a lot more, I don't know, loving and affectionate to her than I probably would have been if I'd have had a boy first. And there's just something special about daughters. I'm biased, but I'm honest.
Kind of like when you push them off the bed.
Yeah, a little bit. I would always go lay down with her and read her a story before she went to sleep, and we were kidding around or something, and I don't even remember what she said. But she said something, and I just gave her a quick shove. And literally, you could see her whole body just go horizontal. And then the expression on her face before she dropped. It was, not going to lie, it was one of the best moments of my life. It was hilarious. And
you got to remember, Clay is like 6'3" or 4'3".
3.89. How's that?
6'4". Excuse me. And his daughter is what, 5 feet tall now?
Probably 5'2", soaking wet.
5'2". Okay. So yeah, this is a very large man just kind of joking and pushing a little girl, and she just levitates for a moment, and it's like cartoon, right?
Yeah, the second best thing was when her hands hit the top of the mattress and she pulled herself up, and she was just sitting there looking at me.
You're terrible.
It was beautiful. It was a thing of beauty, and I never let her forget it.
And this man also is the masculine man he is, learned how to French braid hair, did all the little girl things, the ballet things, the everything. He raised Casey by himself for a very long time, excuse me.
Best years of my life. Some of the hardest years, but some of the best years of my life. Wouldn't trade it for anything. I'd do it all over again in a heartbeat. Might try to pick a different mom for her, but nonetheless, everything worked out well. She's all mine. I'd have had her with anybody.
So, because she looks just like you, like literally, like you spit her out.
She does. If she'd have just eaten her breakfast, she'd have been 5'10" or 5'11". But
I don't know about all that.
Her mom was a little short too. But Casey got all the short genes. Everything else, she's mine.
Oh yeah.
And I'm pretty damn proud of it. See, Zanzibar, my sister's in misery, but going to get induced tomorrow night if nothing happens by then. Is this her first? Sometimes the first is a little later coming out. How far behind her due date is she?
I'm looking for. All right,
I remember Casey's mom was in labor probably 18 hours. I don't remember the exact hours. It was quite a while.
That's a long time. With my first, I had preeclampsia. So they induced her early. She was, okay, both of my children were due on December 6th, 2 years apart. Emma was born or induced November 27th. Then Carson, my second, was 3 days late.
Usually the second one comes pretty quick. But
he didn't. He had to be induced too because they were like, I said, look, free rent and board, it's over. He's got to come out. He was, 9 pounds, 5 ounces.
That's solid.
Yeah.
I would guess Zanzitar's sister's in the same boat.
Probably.
Free room and board's about over.
Yeah. First baby. Oh no, that's not good. First baby, a few days behind. Yeah, ouch. They do tend to lag. Of course, my second one lagged. All right, so Clay, what are we talking about tonight?
We are going to cover a couple different talks. We're going to look towards the future. How do I want to put this? To start off, we're going to talk about credit unions versus banks. I actually had some questions asking us to cover the difference between credit unions and banks and why would you want to use a credit union, and also some questions on planning for retirement. So we're combining those tonight, and this is really kind of night that some of our viewers asked for. We will do that. We enjoy doing that. That's one reason why we encourage questions and comments. The purpose of the channel is to help you, help make you a better investor, help make you more aware of what's going on in the economy and the markets. And so tonight we're trying to answer some specific questions, and we're going to have a little fun doing it. We'll start off talking about credit unions. But I believe, first of all, we've got if you're going to look at the current or the future, you have to understand the past. The financial crisis of 2008, which I think probably most of you will remember, left a lot of people feeling very anxious, very uncertain about their bank, their investments. Banks were failing left and right. I think in the first 2 years, 2008, 2009, you had something like 260 banks fail. And then for years, you would have six, seven, eight, nine banks a month continuing to fail. The repercussions from the 2008 subprime crisis were severe, very extensive. It seemed like no one was safe from the chaos. And during that time, a lot of customers of banks actually turned toward credit unions as a more reliable alternative. So now, to be honest, from 2008 to 2010, some credit unions did fail. Mortgages, if you remember, were slammed. Their values dropped, but far fewer failed than banks. So today, the question is, does history repeat itself? Are credit unions a safer alternative to banks? A lot of people are considering maybe moving their accounts to credit unions. Why? What's the difference in the two? Well, credit unions generally are smaller than banks. They are more community-based. They generally have lower fees, lower interest rates, and generally more stable than banks, though admittedly that they can still potentially run into trouble. Now, credit unions often advertise and brag about the fact that they are quote unquote nonprofit, which even thinking about it makes me laugh a little bit, because the difference between a profit institution, a for-profit institution, and a not-for-profit institution is simply that the nonprofit doesn't have to pay federal taxes. It's not that they run different.
Well, let me back you up there for just a second.
Sure.
Okay, so credit union and bank is the same thing, except one does not pay federal taxes?
Profit and non-profit.
Okay. I assume a credit union is like a non-profit.
Like a lot of hospitals say they are non-profit. Okay. This while there's been.
Okay. Explain non-profit versus not for-profit. Is there a difference? Same thing. Okay.
So you've got non-profit, you've got profit. Or just regular, corporations. You've got nonprofit corporations, you've got regular corporations. The difference is the regular corporations pay federal taxes.
Okay.
Nonprofits still have to make money. They still have to make a profit. No business can stay in business long losing money. So the idea is that they take their profits. I mean, they pay their people the same, average wages, salaries, that kind of thing. The idea is they take their profits and use them to benefit the shareholders, the depositors. When you deposit in a credit union, you quote unquote receive shares, as it's called.
Okay.
And credit unions will say, we're not for profit. We don't have to worry about stockholders. Well, a shareholder is actually a stockholder. Yeah. So, I kind of laugh when they try to say that's a different view or perspective, because fundamentally I don't see it. Like hospitals say, a lot of hospitals say they're not for profit. Meanwhile, they are spending hundreds of $millions acquiring new hospitals, et cetera, expanding beds, buying new equipment. Same thing the for-profit hospitals are doing. Instead of having shareholders, their owners are the doctors. So the doctors receive the money. The doctors, quote unquote, are the shareholders. So I'm not real big on the not-for-profit profit difference. Now there are some differences between credit unions and banks. Credit unions are generally more community-based. As I mentioned, they already have lower fees and rates. They do take some of their profits and they pay them out to their members or shareholders, whatever you want to call it. And they maintain generally a little bit more conservative portfolio. And we'll look at that in a few minutes. Credit unions tend to lend more in times of crisis than banks do. They're more about supporting Main Street. They know their customers better, and they don't impose such strict bureaucratic top-down limits as commercial banks are now. I just saw a report where bank lending is down something like $169 billion over the past month. Banks have really tightened their credit standards. They've got depositors running, taking their money out of the banks, so they've got less money to lend. Their loan portfolios are shaky, so they're tightening their credit standards. They're not lending as much as they normally would. Credit unions don't tend to do that as much. They know their customers better. They still will lend to, customers that are credit worthy, and they don't have the bureaucracy, the top-down bureaucracy that a lot of banks do. If you're trying to get a loan from a bank, most of them are large commercial operations, and your local branch manager really doesn't have the say in terms of who gets a loan or not.
Unless you're Russell Laffitte and Alex Murdoch.
Yeah, well, that's a small bank, but they're not, to me, like here in town in Wilmington. Some of our small banks have 200 branches. Live Oak, for example.
Mm-hmm.
I don't know many neighborhood banks. They're rare, increasingly rare. Wells, City BOA, BBT, Regions, all those have bought up, most of the smaller banks. A lot of that is a repercussion of 2008, where the banks were stressed. So credit unions don't tend to be caught up in the boom and bust cycle to the same extent that banks are. Their portfolios tend to be more local in nature. They know their borrowers, and credit unions tend to be more willing to work with their borrowers than banks are. To give you an idea of the comparable risk, in 2008, the year of the recession, banks, 24% of all the banks, 24% of all the mortgages in the commercial banks were subprime, compared to 3% at the credit unions. Now, I've got a question here from Anonymous. Aren't credit unions restricted regarding commercial loans? They're limited because they don't have the size to make a lot of the large commercial loans, but they can still make commercial loans. Like a small branch of a credit union can't make a $50 million commercial loan like a Wachovia branch could, even though they end up passing it through to a bigger branch, bigger office. They can lend for business, personal or corporate. As I alluded to previously, credit unions are also more willing to work with borrowers and avoid delinquencies and charge-offs. So if they have a borrower or individual that they probably know by name has some trouble making payments, if they go in, talk to their credit union, they're maybe willing to try to lower the payment, extend the length of the loan. They'll try to make some adjustments to it. They're more willing to make adjustments than a bank is. They have more flexibility in that regard. So credit unions generally are a little bit more, how can I say it, a friendly environment. They pride themselves on that. So they tend to be a little bit different in nature, even though the function is not that much different than banks. Some of the terminology is a little different, but their nature, the nature of their loans, how they structure, how they relate to their customers is different. Now, between 2019 and September of 2020, credit union memberships increased. And remember, this was during kind of the height of the COVID crisis. The lockdowns and all that started. Memberships increased by about 3.3 million, or roughly 2.8%. Their loan portfolios rose during this time, 6.6%, slightly above the prior year's rate. Banks on the other hand, saw growth at about 4.9%. So, like I say, in terms of crisis or hard economic times, they are still more willing to lend than banks because they know their people better. They know the community, they know the environment, they know the operation that the loan is going to. And if it sounds like a solid deal, they're more willing to do it. Now, credit unions also have deposit insurance, just like commercial banks. They are insured by, instead of the FDIC, they're insured by the NCUA, National Credit Union Association. Now, I got another question here. Are credit unions subject to the same regulations? Dodd-Frank, FDIC, Fed regulators, SEC. Credit unions, for example, aren't subject to the SEC because they don't have stock. The SEC only handles companies issuing public stock. Fed regulators, yes, there are federal regulators. FDIC, no, it's the NCUA. Dodd-Frank applies to any financial institution. So, yes, credit unions are subject to the same regulations as any other bank or lending institution of the same size. Now, talked about the NCUA. Excuse me.
Is that the National Credit Union Association?
Yes.
Okay. Administration.
Here's their website. Right. Here's their website. They were an official website of the United States government, kind of directly answering Anonymous' question. And if you'll notice, they have a .gov web link. By law, anything .gov is reserved for U.S. federal government or agencies of the federal government. So this is an agency of the federal government. And you can, walk through the website and see, learn about the general operation of the system. But what I wanted to point out to you more so was you can go on this website and check, the financial reports of any credit union that you're interested in. So let's kind of walk through that.
Clay, let me, real quick.
Sure.
Can anyone join a credit union?
Depends. Some credit unions, you have to meet a qualification. For example, you have to be an employee. If a company sponsors a credit union, you have to be an employee or family member of the employee of a company. Now, some credit unions will open up their services to people that live in the community. And most credit unions have done this. So even though, for example, Dow Corning has a big fiberglass manufacturing plant here in town, their credit union, Corning, I believe, will take people from the Wilmington area. So a lot of credit unions will do that.
And there's North Carolina State Employees Credit Union.
That as well.
If you're a teacher or work for law enforcement or military, I know not just anyone can be a member from a few years ago, at least.
Right. A lot of credit unions have changed. They will take people from the community. You just have to literally call and ask them, will they take deposits or make loans to people in the community. But if you want to find out about an individual credit union, it's financially anyway, it's really easy. You go to the website, ncua.gov, click on analysis, go down to research a credit union. Okay, now you can enter in some of the particulars as far as a specific name, city, region, whatever. Easiest thing to do is enter a charter number. Charter number. You may not have that readily available, and you may not even know what credit unions are in your region. Or, like Corning, if I enter in a branch of Corning's address, if I'm interested in Corning's financial health, if I enter in a branch, it'll come up with nothing because I actually need the home office So what I can do is click on this credit union locator and tell it to locate me. Okay. And it's going to go by address, city, state, zip. And then I can tell it to find. And it finds all the credit unions in my region. Here's Corning's.
You know, you just put your address up on the interwebs.
It's on the interwebs already.
All right, gotcha.
So here, when I pull this up, this is the info I want. Charter number right there, 1644. Okay. So now I can go back to research a credit union, enter 1644, and it will find Corning. Click on view. And there's the specific, the specific registration information. But what I'm really interested in is down here, the financial performance report. This is a summary of the major data of the credit union.
Wait. Never mind.
If I click on that and I want to view it, let me go. That might have been a little fast. I want to view the summary online. They can mail it to me, email it to me, or I can view it online. I want to view it online. Okay. Now here it asks for the cycle. It's every quarter, and the quarter just ended January, February, March. So they probably haven't completed that yet. So I'll pick December's. Now I can ask for the financial summary, the key ratios, or the historical ratios. Let's start off with the financial summary. Now this is a bunch of numbers. And a lot of these numbers I don't really care about. If you're going to evaluate a business as far as whether or not it's stable or safe, the one thing you're interested in is cash flow. And I don't know how many of you are familiar with accounting statements, but a lot of the numbers will include, like, for example, depreciation. If I'm a company and I buy a car, I'll spend $30,000 on this company car. Well, instead of being able to deduct that $30,000 on this year's tax return, I have to depreciate it, which means I take 1/3 of the purchase price of that car and deduct it each year. So that's a mythical deduction. It has no bearing on the wear and tear of the car, how much I use it, or whatever price I paid for it. It's just a percentage deduction every year. So that kind of myth included in the financial statements distorts the actual cash flow. So what I'm interested in is in numbers that don't have that kind of distortion. I'll look at cash and other deposits, the first line item under assets. Now the dates, December 21, March 22, June 22, September. So it gives me for the last 5 quarters and the percent change. So if I look at cash, 292 million, 469 million, 357 million. Now, there's a lot of variety here. And I see that from September 22 to December 22, it dropped by about $75 million. That's pretty significant. But in this day and era with the run on banks, that's probably not surprising. Okay. So if I go on down, and look at total shares and deposits, 1.9, 2.61, 2.38, 2.07, 1.96. You can see that they've been having a little bit of a run too. Not a whole lot of change since December a year ago, but some volatility during the year. And some of that may be due to, like this bump could be due to in March of 22 from December 22, could have been due to people depositing tax refunds, for example. So expect some variation, but overall their total shares and deposits is holding pretty steady. Now, what
Can
I'm
you go
really
up
interested,
just a minute? Can you go up
yeah,
just a little bit? Sorry, I have a question. Oh,
sure.
okay. Okay, loans held for sale. They had none for 2 quarters.
Yeah,
Sorry,
I
I'm
wouldn't
just
worry.
looking at.
Yeah, that's
Okay, go ahead.
fine. What I'm really interested in are these two numbers: interest income and interest expense, net interest income. These are numbers that really aren't subject to any accounting myths or alteration. And when I look at interest income, I see it at 60 million, 16 million, 35 million, 54 million, 75 million. So their interest income is growing steadily, strongly. I like that. The more income they have coming in, the more stable they are. But the big comparison is between it and interest expense. What's going on with interest expense? 9 million, 4 million, 7 million, 11 million. Well, they're raising their rates on their deposits, but it's increasing slower than their income, which means their net interest income, 50 million, 14 million, 30 million, 47, 64, is still very healthy. That's really the main indicator or measure of the health of a credit union that you can look at easily. Cash flow. Cash is always king. So now some of these things like non-interest income, non-interest expense, those can be a lot of one-time charges. I don't really care as much about those. Net income or loss, like I say, it's a mythical number because it has mythical numbers input into it, like depreciation, accruals, accretion, all sorts of, I refer to them as accounting mysticisms. So just looking at the glance, they really don't tell me, net income doesn't really tell me anything about cash flow. The company or the credit union could have strong cash flow, but weak net income due to these accounting mysticisms. So what I really care about, interest income, interest expense, net interest income. Now, if you have questions about this, please don't hesitate to ask, because I want to make sure that everybody's reasonably comfortable with it. The idea of this is that we are having what I consider to be a banking crisis, where people want to make sure or have some confidence that where their money is deposited is safe. And who's going to tell you it's safe? There's really not anybody out there that's going to look at your particular bank, your particular credit union, and tell you that it's safe. So, this is kind of a quick and easy way, relatively quick, relatively easy to look at and see whether or not your credit union has good cash flow, is healthy. Interest income is growing and growing faster than interest expense. That's a good sign as far as the health of the institution. The idea of showing you this is that I want you to be able to do it and look so you can stay informed. This is something that if you're concerned about banking crisis, if the banking community is in a lot of turmoil, this is something that you ought to check maybe 2 or 3 times a year for your credit union, because it's hard finding good information. You can't exactly ask the branch manager or the president of the credit union if they're healthy and safe. What are they going to say? Of course, they're going to say, we're safe. Second thing you can do is make sure your funds are insured. Now, the credit unions, just like the banks, have deposit insurance up to $250,000. Same coverage as the banks. If you have more than that deposited in a bank or credit union, you probably need to move it into another bank, another credit union, or buy treasuries. You can buy treasuries direct. You can participate in a treasury auction, or you can buy a treasury mutual fund, an ETF, if you have a larger deposit account. So there are a number of ways to handle larger deposits, but you always want to make sure that you're not at risk, particularly when there's a lot of uncertainty in the economy and banking crisis going on. I like the idea of credit unions. They are generally a little bit warmer institution and generally a little safer. Now, Sandra asked a question. What is a treasury auction? Treasuries are government bonds. They can be short term, like mature in a month, 3 months, 6 months, or a year. They can be longer, have maturities of 3 years, 5 years, 10 years, even 30 years. So that's how the federal government borrows money. It sells bonds. So you're basically making a loan to the federal government. If I buy a 6-month, and bills are the name for the short term, bonds are the name for longer, anything with a maturity over a year. So if I buy a treasury bill with a 6-month maturity, I'm lending the government my money for 6 months, and they're paying me a stated rate of interest. And the way that interest is determined, the way that the bonds are priced, is through an auction process called a Dutch auction. Let me do this. All right. Let's say that the Treasury is going to auction 15 billion worth of 6-month T-bills. There are two different types of bids. There's non-competitive and competitive. Non-competitive are the people who don't put in a specific price. If I want to buy $10,000 of a treasury of this T-bill that the government is going to sell in a week, I put in a non-competitive bid. I don't care what the yield is. I pretty much know what the yield is going to be because I know what the current rate is on 6-month T-bills, and this rate will be comparable. But I don't put in a specific price that I'll take. I'll take whatever the auction price is at. So the Treasury gathers all of these non-competitive bids and puts them in one lump amount. Let's say out of the 15 billion being offered, that 5 billion are non-competitive. So that leaves 10 billion for auction. Well, the auction, the only ones that can bid are the large banks. There's about 36 of them that are qualified to bid, like Chase, Citi, Bank of America, UBS, Bank of Tokyo, these huge international banks. Some people refer to them as primaries. They actually put in a price or a yield that they want to receive. So once the bidding is closed, the government takes the lowest yields. Obviously, it wants to pay the least amount of interest. So maybe it will have somebody, Goldman, who bids 3 billion at 3%. Then they'll have somebody else that bids 5 billion at 3.1%. So that totals 8 billion. Then somebody else bids 3 billion at 3.2%, but only 10 billion is available. So instead of awarding them the full 3 billion, they only get 2 billion. So all of the 10 billion has been awarded, and the price that everybody gets, including the non-competitive, is the last price accepted. So this
Clay,
treasury
you
bill
can't,
will price at 3.2%.
Clay, you can't see that on
Ah,
the screen.
sorry. Well, I'm not very good at this, but I hope that gives you the idea that they've had different bids at different prices. They've awarded those bids with the lowest price, I'm sorry, the highest price, the lowest yield first. Remember the teeter totter? Price and yield are inverse, and they want to pay the lowest interest they can. So they accept the lowest interest first, the next lowest interest, and on down the line till they fill the remaining bids. So the price that everybody, the non-competes and the competitives, get is the last bid accepted. So everybody gets 3.2% in this example. Does that make sense? Okay. If it doesn't, let me know. But that's how a treasury auction works. So if you want a treasury bill, if you've got, I don't know, 300,000 in a credit union or a bank, 250 of it's insured. You've got 50 that's not insured. So you can go online, treasurydirect.gov, and you can put in a bid. I want $50,000. And, that week when the Treasury closes this bid, you'll be able to buy $50,000 and receive the interest rate that was awarded at auction. So now you've got your 250,000 that's insured. You've got the 50,000 in a short-term Treasury bond, which when it matures, you can go through the auction process again and put in another non-competitive bid. Okay. So you can do that, or you can, through your brokerage, you can buy Treasury ETFs, that kind of thing. Got a question from Zanzitar. I just got some bonds back from my mom that were bought for me when I was born little. They barely appreciated. Is that normal? Unfortunately, yes. She probably bought, what do they call them? E-bonds.
Savings bonds?
No. Yeah, savings bonds, E-bonds. And they had a very, very low interest rate. Do you remember me telling the story of the little old redheaded lady?
If they haven't, it's a good story.
Let me just give you this because I do think it's a good example. I was working kind of in venture capital, structuring Reg D offerings, and had a priest call me. Said he had a parishioner that was retiring and coming into some money and didn't know much about money or finance. And he heard that, I would work with people on occasion. I really didn't take individuals as clients, but told him that I would try to help if I could. And so a few days later, this little old redheaded lady came into my office. Just a dear, sweet, precious soul. She had just had her hair done strawberry orange. It stunk to high heavens, but she was so proud of it. She was so cute. And so we started talking, and she told me her story that her husband had been killed in the Korean War, and she received a death benefit from the Defense Department of $10,000. Now, today, $10,000 doesn't seem like a whole lot, but in the mid-50s, it would buy 3 houses. 3 small houses, 3-bedroom, 1.5-bath houses. So after the funeral, she was approached by a gentleman, one of her neighbors, and said,
Damn
Polly,
insurance agents, they're awful.
I'm not going to, indict him. He may have been trying to do the best he could at the time. But the lesson still remains. He said, Polly, I know you'd be a conservative woman, don't have a whole lot of experience in money or managing it or whatever. And he said, if you want your money protected, if you want it guaranteed, I can do that. I can help you. And so she said that sounded good to her. So she gave him the $10,000, which he proceeded to put in a 30-year fixed annuity at 1.25% for 30 years. So the 30 years was up, and she's retiring. She has worked all of her life for a father-son law firm, and they don't have a retirement plan. So what she has to retire on is a $232 a month Social Security benefit and this money, which the insurance company was going to write her a check for $17,000. So $10,000 at 1.25% for 30 years came to $17,640. That and $232 a month was what she had to live on. Now, she had two main loves in this life, having her hair done, and she had a little puppy, a little poodle that she adored. I'm the one that got to tell her that she could no longer afford either one because she couldn't pay her rent and food. Now, suppose instead of 1.25% for 30 years, like a Series E or double E bond, suppose she had invested it in a mutual fund in the stock market and earned. You have to understand, during this time, we went through 30 years. We went through two of the greatest bull markets in the history of the country. A blind pig in a poke could have earned 15%. The historical 75-year stock market average is 12%. So this is just slightly better. But if she had invested in that, she would have had over $660,000. Now, suppose she had a good mutual fund that was well managed and just does 3% better. She would have had about $1.3 million. Now, do you think she could have retired in mid-80s off of $1.3 million?
Yeah.
Yeah. Hell, I could retire off that today.
Okay. So there's some people in the chat. Sue Magic and I'm sorry, I'm going to call you Toots because I love the Toots. But if you have a lot of bonds, such as these double E's that Toots said was what she had, would you be better off putting it in a money market account or a mutual fund than keeping them in bonds?
Well, two things. One, if the bonds are if they're double E, I think they're 30-year bonds. If they're more than 30 years old, they've capped. They won't pay any more interest, even at the low rate. Secondly, they pay, I don't remember what it is. It's low, maybe 1.25%. I don't know, honestly. I don't remember, honestly. But yeah, I think you would be far better off, particularly if you've got time. And we'll look at time in a minute. They would be far better off in a money market and far, far better off in a mutual fund, which we'll talk about mutual funds in a minute.
Okay. And we have a friend that would buy life insurance for her grandchildren to pay for college. Because Let me put it to you this way. If you have money built up in your life insurance and you're healthy, you're never going to get paid more than your death benefit. They're not going to say, okay, here's the cash you put in plus your death benefit. Correct? We're both licensed agents. So if you have a whole life insurance policy and you have, let's say, $10,000 in that, and you're healthy and you can get a good rate, cash that out, invest it in something else, in my opinion, rather than lose that 10 grand because you're not going to get any more money than the death benefit, correct?
Yeah. It caps out. And the same with the bonds. You're going to get an extremely low interest rate. And I'm about to show you how you can determine what the dollar difference would be looking at some of these different alternatives. So give me a few minutes and then we'll revisit this issue of the return and time. Okay. Let me just finish up with credit unions real quick. Let me answer this question real quick. Zan's tired. Okay, so can I take them to Schwab and put them in a money market? Yes, you can. I believe you can cash them out, and you probably have to take them to your local bank to cash them, put them in your account, and then send it to Schwab. All right, just finishing up real quick.
Sorry.
That's all right. What you got?
You were also saying that you could set up a mutual fund, right?
Yeah, but I said I want to talk about those in a minute. Yeah.
Okay. Go ahead.
Yeah, let me delay that. Okay. Because we are about to talk with that when we get to retirement.
Gotcha.
With just finishing up on credit unions, my opinion, smaller can be better. The one caveat is to check and make sure that depending on how small your credit union is that you're thinking of going to, that they have the ATM access, they have the debit or credit cards that you utilize or want to use, or that they have the ability to transfer money between your broker or your mutual fund and your credit union account. Most credit unions should have, but a few smaller ones still may not. So that's just something that you want to check and ask. Now, retirement. Then as we go along, if you think of some questions on credit unions or whatever, don't hesitate to ask. We'll have a Q&A session at the end, but I want to go ahead and at least cover some of this on retirement because it directly applies to what we've been talking about. Now that you know how to protect yourself from a credit union crisis, you know, the idea is planning for the best days of your life, which I consider to be the best days of your life, your retirement. Now, honestly, best days of my life were my daughter. But when you're retired, you get more time with your kids. You get to do the things that you've been working for. Now, you want to enjoy your life without worrying about financial stress. Now, unfortunately, not everyone is adequately prepared for retirement, and that can lead to a crisis of its own. This next hour is particularly directed at those who don't have a great corporate retirement plan or financial planners who can offer advice. But even for those who do, hopefully this will help you make better informed decisions. Now, it takes one of two things to make money. It either takes money or it takes time. Either one of those things or both. The idea is if you don't have money, you have time. So let's take a look at money and time, the impact of time. Time provides for the miracle of compounding. So, if you will, Google financial calculator. And if you do, you'll get a number of them pop up. I just use this one, calculator.net. Calculator.net. Finance calculator. This will be financially one of the most important tools you'll ever have, and you'll use it often. So, the example that I use for my kids, my students, I call them my kids, is I ask them, how much do they spend a month going out drinking, partying, whatever? And I get all sorts of ranges of answers. But I tell them, try giving up one night a month. A year from now, 10 years from now, 50 years from now, you'll never even miss it. You won't know what you gave up. And take that money, let's say $50 that would otherwise be spent on booze, and invest it. If you start that at age 20 and you retire at age 70, what good would that do you? Okay, there's where the financial calculator comes into play. Here, I've got different tabs. FV, payment, I to Y, NPV. FV is the future value. Payment is how much I'm putting in each period. I to Y is the interest rate each period. N is the number of periods. And present value is the amount that I start off with today. So if I'm just starting an investment of $50 a month, and I'm 20 years old, and I can do it for, what did I say, till you retire at 70? Is that 50 years? So that's 60 months. So number of periods is 600 months. It's 600 months, sorry. And if I get the stock market average return of 12% a year, well, that's 12%, that's 1% a month. And then I start off with zero. I don't have any balance to start off with, and I'm putting in $50 a month. What do I end up with by the time I'm ready to retire? Calculate. If I do that, I will have almost $2 million saved up. And that's only putting in $50 a month. Now, what if I think, hey, in 5 years, I'm going to get a job, I'm going to get a raise. What if I bump this up to $100 or $200 a month? Well, you can use this financial calculator to solve that problem. Down below, all right, now. Well, last time I did this, it had a table down below. Okay, well, this is irritating.
Is it the investment calculator?
Yeah, they had a table down below showing the month-by-month balance.
Is that the one that you hit? I'm pointing out like you can see me. The third one over on the related. These? No, down.
No.
Keep going right there. Is that not it?
Monthly schedule. That'll work. That's not the one I saw, but this will work beautifully. Thank you.
Welcome.
All right. If I everything changed. Starting amount, 0. $600 months, 1%.
That one's years, not months.
It's about to be months.
Okay. It still says years. 600 years.
Huh. Well, it's selected for month. All right. Well, I'll tell you what, let me go back to the one that worked before. Okay, back to 1.92. Let's say after 5 years, I could increase it. Well, what I have to do, 5 years times 12 months is 60. So if I just run that calculation for 60 months, nothing else changes. I find out I end up with $4,000. So now I go up here and I have a present value of $4,000. I know that I'm going to change my monthly investment to $200 a month. And I was doing it for 600 months. Well, I took off 5 years, which is 60 months, right? So now I've got 540 months left till I retire. Everybody with me? So if I do calculate, now all of a sudden I'm up to $5 million. Does that make sense? So I can use this calculator. I can use it to calculate a car payment. I can use it to calculate a mortgage payment. I can use it to calculate potential. If I have a goal of future value that I want to get to, and how much do I have to pay to get that? Well, if I'm going to retire in 20 years, that's 240 months. I'm going to say I can still earn the stock market average of 12% a year or 1% a month. And I start off with $1,000. Okay. My future value is I want $1 million. One more zero. Calculate. I need to invest $1,000 a month.
Now it says interest per year, 1%.
Yeah, ignore that.
Okay. Is it not doing it right?
No, it's doing it right. It's just terminology. Let me go back.
I'm sorry. It's just confusing to see that.
Yeah, I understand, but it's irrelevant. And I'll show you why. In a calculator, you've got the 5 buttons. In, I to Y, payment, present value, future value. 5 buttons. 2 rules you've got to remember. These 3 all have to have the same time reference. Time reference. If I'm looking at years, N is my number of periods. I to Y is my interest rate per period. Payment is my payment per period. So if I'm looking at years, I put in my yearly interest rate. I put in my yearly payment. All 3 have to have the same time reference. If I'm doing monthly, N is my number of months. I to Y, my interest rate is my monthly interest rate. So I take my annual rate, divide it by 12. Payment is my monthly payment. Okay. So I've always got to keep those 3 consistent: quarterly, monthly, daily, yearly, whatever. They all have to be the same time reference. Now, the second rule, payment, PV, and future value, the actual cash flows. The calculator doesn't know whether money is coming to you or away from you. So if you're investing money, it's going away from you. If you're receiving money, it's coming to you, right? That's very different. Very different. So the only way the computer or calculator knows which direction the money is using a plus or minus sign. Money coming to you normally is positive. Money going away from you is negative. So if I'm making a payment, that payment is negative. Then when I do the calculation, my future value will be positive. Okay. So those are the two rules, the time reference and the direction. So in the calculator here, whatever my time period is, and I'm using monthly because most people will invest something monthly. I can do it bi-weekly. If I get paid weekly, I can do weekly payments.
So, okay, the number of periods, and it says the interest per year.
Yeah,
that would not be 12%, or is
ignore
it just,
that. Ignore that. It's just I to Y.
Okay.
Okay. Ignore interest per year. Pay attention to I to Y. I don't know who
Because
made
you're
the
doing
table.
because you're doing per
A
month.
different
You're
period than
1%
year.
per month. Okay, gotcha,
Yes.
gotcha.
Yes.
That makes more
And
sense.
I could do it weekly. I could do it every 2 weeks. I could do it once a year, whatever. I just need to
So you
make
did-
sure that it.
So if you did it like once a year, you'd put in 12%.
Yes.
Okay, and if you did it weekly, I'm not going to divide those numbers. Sorry.
It would be 52 weeks in a year. So if I was
Right,
looking at
right.
a 10-year period, it'd be 520.
And then your interest would change to
It would be weekly.
divided by 52.
52.
Yeah.
Right.
Okay.
And
Just
the
so
blue
we're
tabs.
straight on math.
Sure. The blue tabs are what we're trying to solve for. In this case, I want to know how much my payment would be given these conditions. If I want to know how much I will have if I put this amount of money, if I have it in a present value investment, if I put it in a monthly payment, my monthly interest rate, number of months.
Gotcha.
So this can be a very helpful tool to try to determine what I need to do, what I can do in terms of future retirement plans. If I'm 35 years old and I'm going to retire at 70, so I've got, let's see, 35 years. That's 420 months. I think I can earn the market average over that time. I've got $5,000 to start off with. I can put $200 a month in. Notice I've got the negative sign. I'm investing $5,000 a month. So that money is going away from me. I'm investing 200 additional a month. That is going away from me.
Right. You're just the 5,000 is the start payment.
Right.
Not per month.
I've got that much in a savings account or in double E bonds. I put that in the fund. I add $200 a month to it. I end up with 1.6 million. And that's if I start at age 35.
Not bad.
So does that make sense? Everybody have a little bit better feel for how to use that calculator and play with it? Because, if you want to know what kind of mortgage you can afford, if I'm going to do a mortgage 30 years, that's 360 months. And my mortgage rate is 6% a year. That's 0.5% a month. Okay. My present value is, maybe I'm looking at borrowing $200,000. And my future value, I'm going to have that loan paid off in 30 years. So the future value is 0. Calculate my payment. My payment will be $1,200 a month for $2 million. Is that right?
That's 200,000.
Yeah.
Isn't it? I don't have my glasses on.
Yeah, that's 20,000, 200,000. So you can use this to help determine your payments. Okay. What if your interest rate is 4% per year? Well, 4 divided by 12. If I can work a calculator, 4 divided by 12. Actually, I could do this in my head.
It's 4 divided by 12.
0.3333. That would change my payment to $954. So I can use this to do all sorts of what ifs and determine my payment. I can determine what interest rate I need to get if I know what my present value is, what I want for my future value, how much I'm going to pay each month, and how long I've got. I can calculate what rate I have to earn to get there. So you've got all sorts of options here. Once you understand those 5 inputs, and remember the 2 rules: consistent time periods and direction of cash flows. Sounds tired. I don't have that much to invest, but I want to do what I can. Absolutely. That's the big thing, is getting started. Time is your friend. And even at $50 a month, it can make a big difference over 5, 10, 15, 20 years, 30 years.
And Clay, I wanted to bring up, I'm sorry, go ahead.
No, go ahead.
Jumpstart.org. Apparently April is Financial Smarts for Students, or Financial Literacy Month for students. They have a free course, booklet, whatever, that you can download for your children to learn about finance. They'll get any better information than right here on this channel. So like, subscribe, turn notifications on, all those good things. But it is, I remember I took my 16-year-old son when he was 16, now he's 19, to one of Clay's classes, his basic finance classes. And he came home and he said, "Mom, Clay, why don't they teach this in high school?" And I said, "That's a really, really good question. They should, because this is something everyone needs to know. Everyone needs to know how to manage their money." Oh, don't do that big thing. There you go. Thank you. Anyway, just want to throw that out there. It is a really, really good thing to do. And the free information they have on there for kids, thumbs up.
A lot of people just don't understand that time provides for the miracle of compounding. Time is your ally. And it really is a more important variable than, it's more important that you get started. That'll make a difference. Time is your ally. Now you can also, if you're looking at planning for retirement, you can use certain investments like an IRA or a 401k if you own your own business. That will help, that will allow the earnings to grow tax-free or tax-deferred. Now, we talked briefly, for example, about IRAs, the difference between a Roth IRA and a traditional IRA. With a traditional IRA, you put your money in and you can deduct it from your taxes. And then when you retire 10, 20, 30 years from now, you take the money out each month. It's taxable, just like your salary. An alternative to that is called a Roth IRA. When you put money in a Roth, It's not tax deductible. It does grow tax deferred. It does grow tax free. And when you take it out, there is no taxes on it. So it's kind of a pay now or pay later alternative. Traditional IRA, you pay taxes later. Roth IRA, you pay the taxes now. But if you're in a low income or tax bracket or whatever, and the IRA deduction really wouldn't help you on your taxes, then do a Roth, because not having to pay taxes 10, 20, 30, 40 years from now will be a nice advantage.
Yeah, I mean, how many times have you known taxes to go down?
Exactly. Now, the idea about the investing is discipline. The idea for many people who are on a tight or more restricted budget is, what can you give up? And this question I ask people: what can you give up to improve your future, to improve your investing? Just ask yourself, is your future important to you? Is it more important than some of the things you spend money on now? What can you give up to improve it? Some think it is painful to give up things now, but most of the people that I know who have actually done it really enjoy seeing their savings grow. It makes them feel more secure. It makes them feel more in control, especially as they get older. So my question or statement to you is, do you want to improve your future? If so, what can you give up now? What can you change now? What are you spending money on that really doesn't benefit you? Now, that's kind of I think, our hope incentive for you to start. But how do you start? What are the little devil in the details to get started? I talked about mutual funds. Mutual funds are just simply where individuals get together, pool their money, and hire somebody to manage it full time. That's all it is. And there are families of mutual funds that allow you to electronically, over your phone or your computer, to move money around between the mutual funds, between your mutual fund and your checking account. It's really that easy nowadays. So I suggest or recommend for most people mutual funds, because it's not hard to pick out a good stock. It's hard to know when to sell it. And that's the difficulty a lot of people have with individual stocks. Also, with mutual funds, there are several different types. There's no load versus load funds. Load funds have a sales commission. So less than 100% of your money goes into the fund. You're paying somebody a 3, 4, 6% commission when you invest in that fund. So if you put $1,000 in, only $940 goes in. There are also no load funds where $1,000, you invest $1,000, $1,000 goes into the fund. 100%. There's no sales charges. And that's what I generally recommend for most people. Also, there are mutual funds out there that you can invest in with no minimum balance. You can open up one with $50. Yeah, a lot of mutual funds will take a $2,000 or $3,000 or $5,000 minimum. Well, this is a list that I found that I thought was actually pretty decent, of no load stock funds that are relatively decent performers that you can start off with no minimum investment. Schwab has an S&P index fund and what they call an international core equity. I like international funds. I probably, would have the bulk of mine in U.S. stocks or funds, but I like international funds because there are some areas of the world that for a period will actually outperform the U.S. That's a good thing. Vanguard, total stock fund. But here's just a list of 10 funds with no minimum and no sales charge. So there are good funds out there. You okay, Ellen?
Yeah. God. The dogs and my knees are banging on the desk. I apologize.
Glad you survived. Sounded pretty rough.
No, it wasn't.
I'm like, do I need to call for CPR?
No. At least the computer didn't fall off the desk this time.
Now, another thing that you can do is go directly to something like fidelity.com, vanguard.com. These are two huge mutual fund families, and they have largely no load funds. Fidelity, I have no idea how many funds they manage on their own. It's probably 300 different funds. They allow access to over 10,000 funds. But you can go on this website, for example, fidelity.com. And I do want to say up front, Fidelity doesn't pay me. You will not give them my name, my information. You don't go to a web link that I give you with, my particular code hidden in it, whatever. Fidelity doesn't pay me a dime. I don't take a dime from Fidelity. So if you invest in this, I receive nothing. So I have no personal bias per se, financial interest in you opening an account here or at Vanguard or at any other mutual fund family. But really the only thing you need is go to fidelity.com, vanguard.com. There's a button, open an account, click on it. What do you want to open? A Roth IRA, a traditional IRA, a brokerage account, or just a regular mutual fund account? So just click open now. You're a Fidelity customer? No. And really all you need is your name, address, and a driver's license. Okay. They do have to quote unquote know their customer, but it's very easy to sign up for, and then you can set it up with your bank checking account and they'll automatically pull out $50 a month, or you can manually send them $50 a month or $100 a month or whatever you have that particular month. You can do it both ways. Now, for our international viewers or friends, most of these large fund families are international. And so you can call them up and invest in any currency you want. I say any currency you want. There's probably 20 or 30 currencies that they accept. There's, I guess, quite a number of very small ones in the world they don't really deal in. But this is applicable to anybody in, one of the major G7 trading currencies. So you can invest in euros or yuan or pounds, whatever is good to you. There's a number of international funds or American funds that you can invest in. Also, you want to keep in mind, I just saw Anonymous's comment, Clay, get her a seatbelt and a helmet.
Oh, stop it. Y'all don't okay, at almost 5'9", I don't know my dimensions yet. Like I just, at 46 years old, I still think I'm smaller than I am. And I'm just not. It's not, I had to, the desk that I was sitting, well, I guess I'm still sitting at it, but last week is like my son's old desk, and it's like for a 7-year-old. And I was like, okay, this is not going to work. So now I'm sitting on a bar stool with my computer on top of the hutch on top of the desk, which is a weird thing, but it works out much better. And so whenever I move my knees or adjust, my knees bang into the bottom part of the desk where I should be sitting if I was 7. It's just weird. sit on the floor. You have less distance. I have not fallen ever. At least not on this stream.
Not on the stream. I would not say ever.
No, not ever, but not
Yeah,
on the stream. Is it a
definitely
long?
not ever.
No, there was the time that the dog tripped over the wire on the computer, and people thought that I fell, and I was like, no, that didn't happen.
I had some
felt kinda
folks
bad.
getting mad at me because I didn't jump up to see what was, wrong with Ellen. And I heard her yelling at the dogs. I knew what had happened.
I
She
said,
didn't
"Chalk!"
fall. Yeah.
No,
And
yeah.
I was kind of laughing, and they're like, he's cold. He's just a cruel dude. But it's like, I know Ellen, I know the dogs, I know that voice echoing down through the halls.
When
Yeah,
I go,
she's fine.
"Chunk!" Yeah, it's all good. You have a footstool because you're short. Oh, honey, Sandra, I'm so sorry. I do not have that problem. Yeah, I'm that weird height because I'm long waisted, so all my height is like in my torso. It's just weird. It's weird to find a place to sit that's comfortable and the light's okay. And I mean, we've tried many things.
And walking is sometimes difficult.
Walking can be.
Steps
Steps can be
ladders
hard.
ladders
Ladders,
but I digress.
broken hip, Sue Clay, nice return. Oh, that was funny. I know I'd show this thing. There we go.
Let's see, where's that block function?
He's kidding, not a mouse. That's funny though.
I didn't think so.
Ha ha ha.
Retirement, cash management. Okay. So signing up is easy. And keep in mind, if you're over 50, you have generally higher contribution limits on many of the retirement plans. Some of them allow for catch ups if you haven't fully participated to the max or done the max contribution previously. So there's some options available to you. If you have, I'll say general questions. Obviously, I can't give out specific investment advice. I'm no longer a registered investment advisor, so it's properly illegal for me to do. But I can give you general advice. I can tell you what I'm doing, kind of thing, or what I would do, and you can consider that. Yes, ma'am.
Let's do a little disclaimer there. He's not a financial advisor for any reason other than he just chose to give it up.
Yeah, I teach now, and gave up my registrations and my practice, etc. Love what I do now, and I try to work with people to help them understand better what they should be doing, give them better information without making specific recommendations, if that makes sense. Now, so I think we've covered hopefully incentives to invest in terms of what the future holds, kind of the miracle of compounding, trying to help you calculate what you could be saving, should be saving, want to be saving, what kind of, what amounts do you want sometime in the future. We've talked about kind of how to actually open up the accounts. And now once you get the account open, you'll probably start off putting your money in a money market fund. Get 500 or 1,000 and move it into a stock fund. Or you may want to start off just directly investing in a stock fund, one of those that I showed, or one of the comparable ones on Fidelity. And that's really the deal. Fidelity has 300 funds that they manage, and probably 10,000, literally 10,000 different funds that they offer you the ability to invest in through them. So which one do you pick? How do you pick? if you're interested in maximizing your return with relatively modest risk, then stocks. And I would generally recommend stocks for most people. Now, if you've got, $10,000, $20,000 and you're getting married and you want to buy a house in 6 months, I would not put it in the stock market. Time period's too short. But if you've got 5, 10, 15, 30 years to retire, I'm pretty confident, based on history, consistent history, very consistent history, that you'll be far better off investing in stocks than you would be in bonds or just leaving it in a money market account. It's not even close. Remember the difference, the little old redheaded lady? There's so many, investing principles there. It's not funny. Remember, I went from 15% to 18%. It's only an increase of 3% a year, which you think, no big deal. But her account value changed from $600,000 to $1.3 million. So that's the miracle of compounding, that miracle of time. So, I generally would recommend some well-performing stock fund. Now, how do you know which one out of the thousands? Well, if you go on the fund websites, Fidelity's or whoever's, they have a performance history for all of their funds. And you want to look for a fund that has performed well the last 3 to 5 years, one that's not just a one-hit wonder. You want one that consistently performs well. Now, it may during this time, like the COVID, in the market dropped a fair amount.
You can't say that word on YouTube. You can't say that on YouTube.
What?
The COVID word.
Why can't
say it again? Yeah.
Okay.
You will get stricken. Just don't say it.
That's funny. This is not my era. But there was a market downturn in 2020 for unknown, unexplained, unexplicable reasons. Okay. But the idea is, if you look at their down year, how did it compare to their peers? If they drop less than their peers, they still outperform them. So outperformance isn't just doing better in an up year. It's also doing better in a down year. So you want to look for somebody that consistently outperforms their peers. You can start off by looking at the annual performance of the S&P 500. Now, and I just pulled this off, obviously, the Motley Fool, but showing the performance of the S&P 500 since 2008. I don't know if you can see the numbers clearly, but 2008 was minus 37%. 2009, positive 26, 15, 2, 16, 32, 13, 1.3, 11, 21, minus 4, 2018, 31, 2019, 2020 is 18, 28%, and then in 2022, minus 18%. So if you take that over, a 5, 10 year period, even with the 3 major crises we've had, you still end up far better off than you do in a 3 or 4% money market or 5% bond. Now, keep in mind, there are 18,000, 19,000 different mutual funds out there. Vast majority of managers do not consistently outperform the S&P 500. So you can look at the performance of the S&P 500 and compare it to a particular fund you might be interested in and see how it compares. Is its performance close? Does it outperform? Whatever. Does it, consistently underperform the S&P? That's information for you to make your decision. I probably would not look at funds that try to mimic the Dow Jones. The Dow Jones is just 30 global large companies, already have established market share. They don't have much potential for growth. So, I would probably stay away from there. S&P is kind of a balance, some growth companies, some larger companies. You've got obviously a number of areas. If you look over the next 10 years, tech will probably do pretty well, even though it's taking it on the chin the past year. Healthcare, society's aging, all sorts of new, medical solutions being devised, developed. Energy. People are down on carbon-based energy, but energy is going to become more and more precious as the energy sources are more and more limited, if that makes sense. So you look at these different areas and think, how does that look? Does that look like it's going to be important over the next 10 years? And if so, invest in it. It will probably do quite well. Like I mentioned earlier, I would probably recommend that most people stay away from individual stocks. The risk just ends up being greater because, like I say, it's easy to pick out and buy a good stock. Studies show that 80 to 85% of a stock's price movement is due to movement in the market as a whole. So if the market goes up, the stock's going up. If the market goes down, the stock's going down for most stocks. The problem is not all stocks go up. Some stocks like, I used to use Microsoft as a good example. In the 70s and 80s, Microsoft was a brand new company, market share, everybody was trying to get a personal computer, and Microsoft just went through the roof. Same as Walmart, same as Amazon. But they hit a ceiling where they were 95% of the market. So there's no room for them to grow. It comes a time when you need to sell a stock and buy a better one. And that's what's difficult for most people. Sandra has a question. What should we do if we already invest in a particular stock? I've had Harley since before the resurgence. It's your money. Your real question is, one, what's the best place for my money? This is what I've got today. Whether you're in a loss position or a gain position, this is what I've got today. So going forward, what's the best position for my money? A lot of people get too emotionally attached to a stock and they won't sell it till it gets back to its purchase price, which is silly because they are missing or could be missing significant returns in the market while they're waiting for this stock to move again. So what you've got is what you've got. If you made a bad decision, and it happens if you're in the market, everybody makes bad decisions or bad choices. Sometimes you just, want to survive and live for another day if you're managing a portfolio. It happens. But your question is, what is the best place for my money today going forward? If you think it's Harley, then keep the Harley. If you don't think it's Harley, then sell it and put it in someplace better. If you don't know what Harley's future is, then I would probably strongly consider selling it and putting it in something where there's better management or better opportunity. So, but that's your decision. You've got to decide. I hope that helps. I've made quite a bit of money on it already. I always like to see people making money. I actually love to see people making money. And you know, I sometimes will have um, people say, "Well, you bought this stock. It's immoral for you to do that or take advantage." There'd be times like, um, oftentimes use the example of Chernobyl when Chernobyl blew up. All the news reports were screaming about radiation, flowing through the air and everything. And my first thought was obviously nuclear stocks, uranium. But I also realized at the time that by the time I got a hold of my broker, that those stocks already would have dropped 40, 50, 60%. I missed the parade. So that's the primary effect. The main event, the initial impact, the primary effect. Well, then I started asking, what else is going to be a result of this? So, first thing I had to do was pull out a map. Back then, we didn't have the internet, we didn't have all these phones and stuff. Had to literally find a physical map of the world and find Chernobyl. I knew it was somewhere in the western part of the Soviet Union. That's about it. Finally found it. And I started looking, said the winds were blowing to the west. So I was looking to the west of it, saying, Europe is that general direction, but I was looking for like major industrial regions or, mines or something, but it was nothing, just small towns, villages, very small, just remote country area. And all of a sudden it hit me, it's agricultural. So I started looking, what are Russia's biggest crops? Well, two, potatoes and wheat. And so I thought, nobody likes glow in the dark potatoes. So and this region produced 20%, 30% of the world's potatoes. So what's going to happen to the price of potatoes? Well, boom, I find a potatoes futures contract, buy it. Secondary effect. Secondary effect is potatoes. Well, then I ask, what do they do with all the potatoes in Russia, in the Soviet Union? What do they do with potatoes? Well, they make vodka. Love their vodka. Well, nobody likes vodka that glows in the dark either. So, what's going to happen to the supply of vodka? It's probably going to be cut. So, what's going to happen to the price? Price is going up. So, started buying vodka stocks, tertiary effects. So, anytime there's a major crisis, I'm looking, obviously I try to evaluate the primary effects, but usually you're going to be too late to take advantage of that. So I look at the secondary effects and tertiary effects. And I've had some people tell me, well, that's immoral. You're profiting off other people's suffering. My responsibility is to me and my family, to take care of me and my family. I can't do anything to help the people in Chernobyl, but I can help my family. So I'm going to do that. I'm not profiting off their misery. I didn't transfer any money from them to me. Wouldn't do that. But in terms of investments and other markets, if I've got a chance to help my family, I'm going to do it. I'm going to do it every time. My family is always my choice. And that's what I encourage others. So anytime you see an event, you want to think, what's the primary effect? What's the initial immediate effect? Then what's the secondary effect? What's the tertiary effect? I'm basically asking, what's the primary effect of the primary effect? What's the primary effect of the secondary effect? What does it immediately impact? And usually, if you do that, there's opportunity for you because that hasn't been realized in the marketplace often. Primary effects, secondary effects, tertiary effects. In terms of overall investing, find you a manager that invests in the sector you're interested in, whether it's health, tech, defense, whatever. Buy that fund. Like I said earlier, Fidelity offers over 10,000 funds, even those not managed by Fidelity. So it's a great portal for investing. And there's others, Vanguard and some others. Now, something that's kind of come in vogue is known as target date retirement funds, target date funds. And they're basically funds that take the anticipated date of retirement and use a whimsical balance of stocks and bonds, shifting increasingly to lower performing assets, lower risk assets as the retirement date approaches. While that sounds like maybe a good idea in theory, these funds tend to grotesquely underperform. So if you want a more conservative investment position, then take it. Shift your funds. Find more conservative stock funds to invest in. You can find more conservative funds that still outperform other conservative funds. You know, if you want to shift more into bonds for income purposes, shift more into bonds. But you're better off doing that yourself than you are using these whimsical pre-structured funds. If I just, for example, I call it whimsical. Here is Fidelity's version. They have a series of funds called Freedom Funds, in which you determine your retirement year, select the fund that matches your retirement year, and start investing for your future. And here's where you can pick, I want to retire in 30 years. Ouch.
He's fine.
Click submit, and you get this beautiful combination. And it comes up with some whimsical allocation. Now you're going to retire in 30 years. And it's got 10% in bond funds. Well, and even the mix in domestic equity funds. You don't know what that mix is or who's managing it. You probably can find better investment funds. And 10% in a bond fund with 30 years to go, it only does one thing. It lowers your return by 1, 2, 3%. Remember the little old redheaded lady? 30 years, 3%. It makes a big difference. So I can go and pick, any combination that I want. If I'm going to retire in 10 years, now I'm 21% in bond funds, 47 in domestic equity. And again, they're picking relatively conservative domestic equity funds. Well, if I go over that performance, picking any 10 years of the S&P 500, I'm going to outperform that retirement plan by at least 5%. So I don't really recommend the target date funds, even though theoretically they sound like pretty good. The structure is just completely whimsical, has nothing to do with your particular risk tolerance, your need for return, your goals, any of that. So you are the one that needs to be deciding what to do with your money. Never, never blindly turn your money over to anyone, your future over to someone that you don't know, and more importantly, doesn't know you. You need to know what's going on with your money to ensure it's what you want.
As Clay always says, that if you don't want to handle your money, there's always someone else who will.
Yeah, they'll be glad to relieve you of that responsibility.
Mm-hmm. Now, I had a question for you, Clay.
Sure.
Okay, so Abraham Lincoln gave us, I had to write all this down because it was a lot. Abraham Lincoln gave a speech to the Young Men's Lyceum, and he said, All the combined armies of Europe, Asia, and Africa could not land on our coast and get over the Blue Ridge Mountains and have a drink to one gulp of the water from the Ohio River, we would stop them. If this experiment, meaning the United States, is going to expire, it will expire by suicide. We'll do it to ourselves. Lincoln saw the strength of our country, but the potential disaster if we don't take the advice of Martin Luther King Jr. when he said, "You don't get rid of darkness with more darkness. You don't get rid of hate with more hate. You don't get rid of war with more war." So my question to you is, can you get rid of debt by spending more money as a country?
Simple answer is no. Much like we talked about it the other night, the Roman Empire, the fall of the Roman Empire, one of the main underlying factors contributing to the decline of the empire was the government trying to buy popularity and giving away free food, free wine. They actually encouraged people, farmers, to stop producing and move to Rome to get free food and free wine. You know, California used to be known as the Golden State because you could, go out there, and it wasn't just because of the gold mining in the late 80s, 1800s. It was because it had such a bright and exciting future. You could go out there, find your way, and make your gold. It was just such a booming state. Well, that economic growth has utterly collapsed. Firms and people who can are fleeing the state in droves, and California now leads the country in poverty. It is the most, by percentage, has the most poverty of any state in the country because people kept moving to California to take advantage of its welfare and lax policies. Everybody likes free stuff, and it's addictive. We see it in the markets now. All the institutions, the main financial institutions, want QE to resume. Quantitative easing. That's where the Federal Reserve was literally giving out basically free money. It's addictive. It guarantees them a profit. They don't have to worry about risk management. They don't have to worry about competition. They know that they can get their big bonuses. So free stuff is addictive, but cheap money is terribly expensive in the long run. And we're just starting to get to where we pay for that. All right.
Here you go.
Let's see. Zen's tired. It's also the 5th largest economy in the world, right? I don't know if it still is. It is very large in terms of the overall economy. I don't know the size.
I know they've lost over about 1 million people in the past 2 years.
Yeah, and part of that's paper. It's like Apple is headquartered there, so they count all of Apple's revenues and sales. Well, Apple has got offices all over the world. It's got a big, huge factory here in North Carolina. And so a lot of their business occurs, and their cash flows, whatever, occur elsewhere. It's not all there in California. But like Apple, Microsoft's now headquartered in Seattle. But you've got all the Silicon Valley firms. If you just lifted Silicon Valley out of there, California would fall way down. A lot of that's just paper revenues that really aren't generated in California. Anonymous. Debt for current consumption is a loss. Debt for future investment, roads, education, in the old days, infrastructure. Obviously, it depends on the amount of debt. and the infrastructure. Like in this last infrastructure bill, oh geez, what was it?
Oh, Lord, don't get him started.
Yeah, it's had some just ridiculous expenses. Meanwhile, we're not getting roads and bridges that are getting in worse shape repaired. The problem is that debt becomes a stern taskmaster, and you have to be able to pay for it. We're losing that ability to pay for it. Particularly as rates are rising. The government used to be able to fund 80% of its debt at 0.2%. Now that has risen, is it 2,000% to 4%? So our amount of taxes collected that are spent on interest expense is soaring and will soar even more over the next year, 2 to 3 years. That's a big problem, a huge problem. Another question, credit union versus bank. How much does the NCUA have in their insurance fund compared to the FDIC as a percentage of deposits? Good question. I don't know offhand. Can't give you a good answer. But both of them are backed by the government. They're federal agencies. So should the funds be insufficient, you can expect the Treasury to step in and bail them out. And then they would charge, it's like Fannie Mae and Freddie Mac have increased their fees to cover, even though they were technically bankrupt. They were bailed out, and then they increased their fees to future customers to rebuild their loan loss. Anonymous. Maybe we can get Calvin Coolidge back to lower the debt. Anybody with half a brain would be an improvement.
There were a lot of restrictions on the infrastructure bill, this past one.
Such as?
Well, like, I know there was one instance, and I'm not trying to be political, but where they were going to reroute a highway because where it was placed was, how do I put this? Help me out. You know what I'm talking about.
I don't. You're on your own.
It was, I'm on my own, of course. It was through a lower income Black neighborhood, and they thought that was racist. So they wanted to move it and reroute it. And that was okay. But some of the other highways and road improvements were not approved. And then do we trust the states to actually do what they say they're going to do with the money?
I mean, you look at the COVID spending. What was it? Methodist Hospital in Houston was paid $132 million to administer COVID vaccines.
That's you can't say that. Thank you, Sandra. Lower socioeconomic neighborhood.
Yes.
2/3 of Senate got kickbacks from the whole vax. Let's put it that way.
I'm not trying to be political. I'm just pretty damn sick of DC and all the crap that's gone on in there for years. Both parties. The country's economy is struggling because of crappy government policies. And I've touched on that some in the past. Meanwhile, Nancy Pelosi's been up there forever and has made, come from basic poverty to over $130 million in net worth working in the House of Representatives. Harry Truman once said the only way to become rich being a politician is if you're crooked. I think that's still true. And so you have people who go up there poor and become multimillionaires off their salary. And their salary isn't all that hot, particularly in some places expensive as DC.
Well, I mean, she lives in, was it San Diego, San Francisco? And
San
she
Francisco.
makes 100,000 a year, 140,
180.
80.
Yeah. But for a lot of her career, it was, 120. And like I say, DC's an expensive city. But, be that as it may, we're getting a little bit short on time. So, I just want to close this up and say that it's important that you know what's going on with your money. Knowledge and the wisdom to use it is power. Either without the other is useless. Okay. Our goal, help protect yourself from banking crisis, retirement crisis, and doing so doesn't have to be a daunting task. By following the steps we discuss, we talk about here, you can reduce your risk and establish achievable goals for yourself and improve your future going forward. So we'll take a few questions if there are any. Let's see. Are you familiar with the mob concept of busting out of business? That's what they are doing to us. Not sure that I've heard that term, the mob concept, busting out of business, but it kind of makes an intuitive sense. I mean, we've seen some of the mobs protesting in cities and the damage and destruction they've done. And I definitely would consider the group in DC to be a mob. Kate Lewis, thank you for your insight. You're making me blush. Thank you, Kate. I appreciate it. Very kind of you to say. I hope it helps. And, I'm serious. If you've got some questions or if there's something that I said that didn't make sense, let me know. If you tell, I suck at mind reading. You can ask Ellen or any of my exes. They'll all vouch for me. I suck at mind reading. But if there's something that doesn't make sense, if you let me know, I'll find a way to communicate it in a way that is understandable or that does make sense. Infrastructure bills are graft political payoffs only. Unfortunately, I think a lot of it is pork directed to a specific district or region. I would like to see them just take care of some of the infrastructure that needs repair and updating. We've certainly got enough money. They just don't do it. Mob becomes a partner to your bar, run up to your bill's liquor supplier, food supplier, then there is a fire. Can't argue with that. Sandra, it has helped tremendously, Clay. Thank you so much for your guidance. Thank you for your questions. I think, one of these topics was actually your idea. So I very much appreciate it. And I appreciate you working with us tonight. If all of you get a chance, send Secret a Twitter message, tell her to get well soon and get her ass out of the hospital. We want her well. Sue, what are the basics needed if retiring in 6 years? It's hard to answer that on a general level. For me, I would want some side income. I think everybody kind of needs a side hustle. I love teaching, and I might, continue this channel till the day I die. Hope someday to get it monetized. I might write some books. So I'll have some side income coming in addition. Part of it is I think everybody needs a reason to get up in the morning. Statistics show that men die 6 months after retiring if they don't have something else to go to. So I want a reason to get up for in the morning. I'd like to have a little, I think it'll become increasingly important to be able to grow some of your own food. So I want to have, do like a little homesteading and have a little garden, maybe have a few chickens, maybe a little cow. I saw a thing the other day about a house cow, just a little baby calf in a house, but it was just damn cute. So having a side hustle or some side income, additional income, being able to grow some of your own food, obviously having a place to live that either you can afford or already have paid for. But to me, the main thing is having a reason to get up for in the morning, something that makes you feel valuable. You have a purpose and something that makes you want to get up and get to it. Carolina Beach chickens. Maybe not on Carolina Beach. Won't be here. Yeah.
Yeah, the HOA would not be okay with that.
Yeah, there's some things they tolerate. Chickens aren't one of them. I probably look for a place, somewhere in the mountains where I can watch the sunset and have a decent little garden.
Yeah, I talked Clay into doing this channel probably in August of last year. Or finally in August. I probably talked to you about it over a year ago. And then last August, you finally decided to do it.
Yeah.
And because we have really good conversations about finance and life and all the things. And I thought that he would enjoy this. He's still getting used to talking to a computer screen. That's tough for him. So the more comments and the more stuff going on, the better it is for him. So please do not ever be afraid to say something, because he would rather talk to people than to a little camera on his computer.
Yeah, it is weird for me to sit here and talk in a room by myself to a camera. I think I'm getting a little bit more comfortable with this, but it's still, I much prefer the company of people and having, expressions that I can see. Am I making, like, I go off the screwed up nose effect. If I'm explaining something and I see a lot of screwed up noses, I know that I need to back up or throw in some more explanation. Can't get that on screen. So
that's why I'm here.
Yeah.
He can get an idea of if I understand or not. I'm like, what?
Yeah, that's my screwed up nose effect right there. So very much appreciate your kind words, your support, your patience as we kind of grow, learn, develop this channel. We do want to build something that's useful, that is of value to you in your life, and that, is worth your time. So thank you all. Very much appreciate it. It is a little weird. Takes a little getting used to. Not a mouse. Stay with the channel. It's a grind to get one off the ground. Someday it may go viral. I appreciate the encouragement. That's kind of our hope. I don't care if it gets to be absolutely huge, because I really enjoy the personal comments and feedback. And I've watched some of the larger channels that's hard to get. And so I hope to keep the personal engagement at, at least a modest level. That's valuable to me.
So like, subscribe, share, tell your friends, all the things, so we can keep going. There goes an earbud. We appreciate it. We appreciate you being
much here. And we always are interested in ideas that are of interest to you. So feel free to comment below the video or DM me on Twitter at Moffett on Money. Do all the YouTubey things. Thank you all. Our time is up, and we thank you for yours.
Good night, everybody.
Good night.